Welcome to the deep dive. All right, Polestar's Q2 2025 earnings. It's a bit of a puzzle, isn't it? You've got this huge revenue growth, but then the stock takes a hit. So today, we're going to dig into what's really going on behind those numbers. Let's kick off with those big headlines. First half of 2025, Polestar reports a massive 56% increase in revenue. That brings them to $1.4 billion. And retail sales, also way up 51%, over 30,000 cars globally. I mean, on paper, those are really strong numbers. Looks like people want their cars. But, and here's the kicker, despite all that good news on sales, the pre-market stock price actually dipped, dropped about 2.92% down to $1.33. Investing.com even noted a bigger drop, like 15.78% around the time of the announcement. So how does that even happen? How do you get great growth numbers and a falling stock price? What's the disconnect investors are seeing here?
Yeah, it's fascinating, isn't it? Because that $1.4 billion revenue for the first half, that didn't just meet forecasts, it blew past them.
Huh.
Analysts were expecting something like $730 million. So clearly the market performance, the demand, it's strong, no question. But you're right, that stock reaction tells a different story. It signals investors have some, well, deeper concerns that are outweighing that top-line growth right now. For example, InvestingPro's analysis. It flagged Polestar's overall financial health as weak, gave it a score of 1.55. And the main worries seem to be around debt and profitability. Now, their adjusted EBITDA loss, that's a measure of core performance, but for things like depreciation that actually got better, improved by 30% to $302 million for the first half.
Yeah.
But the reported gross margin, that was negative, a huge negative 49.4%.
Whoa, okay. Negative 49.4% gross margin. That definitely jumps out, especially next to big revenue growth. What caused such a massive hit?
Right, so that huge negative figure, it was mostly driven by a very large non-cash impairment expense. We're talking $739 million. This was related to Polestar 3 assets, and they booked it in Q2. Basically, an impairment means the company has to say, look, we don't think this asset related to the Polestar 3 is worth as much as we thought it was. It doesn't mean cash went out the door right then, but it's an accounting adjustment reflecting a lowered value expectation. Now, if you look at the adjusted gross margin, which basically pulls out that big impairment charge, it actually looks better. It flipped to positive 1.4% for the first half. That's up 4 percentage points from last year.
Okay, so that suggests the underlying operations, excluding that one-off, are improving.
Exactly. It points towards some improvement in operational efficiency. But the overall net loss for the first half was still enormous, $1.193 billion. And that was mainly because of that impairment. So you have this tension, you see. Adjusted figures showing some progress, but the reported bottom line is hit hard by this big write-down, and it looks like investors are, maybe understandably, focusing on that big reported loss.
So great sales, better adjusted EBITDA, even a positive adjusted gross margin. But then this massive net loss from the impairment. It feels like investors are having trouble seeing the operational wood for the accounting trees, maybe, and the impairment is a very big true. What does it really signal, though? Is it just an accounting thing, or does it suggest real problems for the Polestar 3?
That's the million-dollar question, really. While it is non-cash, it does signal a reassessment of the Polestar 3's future earning potential. Investors are probably wondering, does this reflect broader issues in the premium EV market? Or is it something specific to the Polestar 3's rollout or how it stacks up against competitors? It definitely adds a layer of uncertainty.
Got it. Okay, so with that backdrop, strong sales but shaky investor confidence, let's look at where the growth is actually happening, because that might shed some light. Their H1 growth, almost all Europe. A huge 77% of their sales came from there. Really strong performance in places like the UK, Germany, Belgium, the Nordics. So they're clearly doing well in that competitive European market. But the US market, it's lagging significantly, only about 9% of their retail sales. And the CEO, Michael Loscheller, even said pretty bluntly, we will not grow in the U.S. at any cost. That sounds like more than just an observation. It sounds like they're acknowledging major roadblocks there. And adding to that caution, the stock price is hovering much nearer its 52-week low than its high. Suggests investors are really weighing that European success against, well, these other headwinds.
Yeah, that quote about the U.S. is telling. If you look at the bigger picture, the U.S. problems are kind of systemic for importers like Polestar right now. You've got tariffs, obviously increasing costs, and then policy changes like certain EV tax credits just, well, disappearing for them. These things directly push up the price for U.S. buyers and really limit Polestar's ability to price competitively against, say, domestic brands. It's a tough spot. And looking at Q2 specifically, their adjusted gross margin was actually negative 5.7%. That's a big drop. 16 points just from the previous quarter.
Wow, negative 5.7% in Q2. What drove that dip?
It wasn't just one thing. It was kind of a perfect storm. More competition forcing prices down, selling more of the lower margin Polestar 2, those higher costs from tariffs we mentioned, and also negative adjustments to inventory value, meaning they had to mark down the value of some cars they already had in stock.
Ooh, so pressure from all sides on profitability then.
Exactly. A real profitability squeeze in Q2. Lower margin cars, higher costs from tariffs, tough competition, even having to write down inventory value. It really shows the challenge to their unit economics. Even if they're cutting costs elsewhere, like marketing or admin, these pressures are intense. And on top of that, they're managing a lot of debt. Though, to their credit, they have renegotiated their loan covenants, the rules tied to the loans. They got amendments, which gives them a bit more flexibility and shows their lenders are still working with them.
Okay, so challenges, yes, but they're clearly not just sitting back. They're planning for pretty aggressive growth still. They pulled back on specific financial guidance for the next few quarters, which seems sensible given the volatility, but they're sticking to a target of 35% compound annual growth in sales volume between 2025 and 2027. That's pretty ambitious. And they're focused on tweaking the product mix, cutting costs, using carbon credit sales, plus expanding where people can actually see and buy the cars. Sales points outside China are up 40% to 169 locations, added 26 new retail partners just in the first half of this year, so they're making themselves more visible, more accessible, especially in Europe where they're strong. And then there's the new stuff, the Polestar 5, that four-seat GT launching very soon, September 8th in Munich. The CEO calls it a brand shaper, meant to compete with high-end performance brands, even if it won't sell in huge numbers. Is launching a niche, potentially lower volume car like that the right move right now, given the profitability focus?
It's a sharp question. And I think you have to see it as part of a bigger strategy. It's not just about that one car's volume. Because while they're launching this Halo car, they're also making progress on costs. They said the average cost per product is down 8% over the last year. Battery cost specifically down 10%. That kind of efficiency is vital.
Okay, so cost savings are happening alongside the new launches.
Exactly. The Polestar 5 is about elevating the brand, showing off tech, creating desire, maybe pulling people towards the more volume-focused models too. And looking further out, they confirmed the Polestar 7. That's a compact SUV planned for 2028. And crucially, it'll be built in Slovakia with Volvo.
Yeah.
This ties into their manufacturing diversification strategy. You'll have Polestar 3 in the US, Polestar 4 in South Korea, Polestar 7 in Slovakia. It's a clear move to reduce risk, especially around things like tariffs, by not having all production eggs in one basket.
Right. Spreading the manufacturing footprint makes a lot of sense given the tariff issues. And you mentioned carbon credits earlier as part of the plan. How big a deal are those financially?
Surprisingly big, actually. They pulled in $72 million from selling carbon credits in the first half of 2025 alone, and they're targeting over $100 million for the full year. So yeah, it's a significant revenue stream right now. It shows they can monetize their focus on sustainability. Of course, you have to ask how sustainable that revenue stream is long-term, right? It depends on regulations and carbon market prices, which can change. But for now, it's helping the bottom line.
Okay, so a lot of moving parts. Growth targets, cost cuts, new models, diversified production, carbon credits. But funding all this takes cash. How are they doing on that front? You mentioned cash outflows earlier. They ended June with $719 million in cash. That's,
Right.
well, it's something. And they've definitely been busy raising money. Got $200 million in new equity from PSD Investments. That's an existing investor linked to Geasley's founder. Plus, they've secured or renewed about $2.1 billion in loans just this year, including around $1 billion in new facilities. That sounds like pretty solid backing from their partners and lenders. But is it enough, given the spending?
Well, securing that funding is absolutely critical, make no mistake, especially when you look at the cash burn in the first half. They used nearly $500 million in operations and another $322 million in investing activities. That's substantial. They did manage inventory better, bringing it down significantly, which helps. But other factors still led to a high cash burn overall. So yes, the funding is vital, but it's going into a company that's still using cash quite quickly. And as we touched on, they proactively renegotiated those loan covenants, adjusted the targets for revenue and their debt-to-asset ratio for 2025. That ratio basically shows how much debt they have compared to their assets. Getting those terms amended gives them breathing room. It shows they're actively managing the financial situation and acknowledging those significant external headwinds, as the CFO put it.
Okay, so they've bought themselves time and flexibility. But what about the near future, the second half of this year? More spending.
Yes, they actually expect higher cash use for investing in the second half of 2025. That's tied to launching the Polestar 5 and getting the factory in Busan, South Korea up and running for the Polestar 4. So the investment continues, even accelerates in some areas, which underlines just how critical execution becomes now. How crucial is it that those cost reduction plans really deliver and that these new models perform well in the market? It feels like that's essential to start turning the cash flow situation around and getting towards profitability in the next couple of years. There isn't much margin for error.
Yeah, that really puts it into perspective. So summing up, Polestar's Q2 story is, well, complicated. You've got impressive growth, especially in Europe, and exciting new models like the Polestar 5 coming online. Strategy in motion. But under that surface, big financial losses, intense competition, and wrestling with those tricky international tariff situations.
Absolutely. It really paints a picture of a company, as their CFO said, in transformation, dealing with a really tough external environment. Their response seems strategic. Focus hard on costs, diversify products and where they're made, and crucially, keep the funding taps open through equity and loans. It's a juggle between growth ambitions and financial reality. But maybe here's a final thought for you, for everyone listening. In this EV market that's getting more crowded, more competitive, maybe even more polarized, how exactly will Polestar's focus on premium design and sustainability be enough to truly stand out? Enough to overcome these current profit hurdles and carve out a secure, long-term spot? Beyond the look and the green credentials, what's the unique value proposition that convinces buyers to choose Polestar over established giants or other ambitious newcomers and keeps them loyal?
That is the core question, isn't it? What makes them truly essential? A great point to end on. Thanks for joining us on this deep dive today.